Hello, investors. It's Don Vandenbord, Senior Portfolio Manager with Revere Asset Management. Today is Monday, August 8th, 5 p.m. Eastern Time, coming to you from St. Augustine Beach, Florida, with tonight's Revere Market Insight video. State of the market, we are in an uptrend as far as leaders, our short-term trend and our medium-term trend are concerned anyway. Long-term, we're still trending below the 200-day moving average. If you follow us for a while, you know that this is where risk is highest under the market. When we broke below the 200-day earlier in the year, it's when we started getting extremely defensive. Survived the sell-off down to S&P down 23% for the year. And we're bouncing back now. S&P down about 13% for the year. Leaders improved over the last couple of weeks, especially late last week. Definitely, we moved leaders to bullish / uptrend. We've been trending for a while above the 21-day exponential moving average, so that's in bullish / uptrend, and also above the 50-day moving average. Also bullish / uptrend. When I say we are trending, I should be specific. The 5 major indexes that we track in these videos are trending above their short-term 21, medium-term 50, and below the 200-day long-term moving average. So what happened today? Gap up as some euphoria left over from the quote-unquote Inflation Reduction Act. I'll leave that to you, whether you want to agree with that or not. Gapping up, futures were up nicely. Then before the open, NVIDIA came out and warned of a revenue miss, and a big revenue miss, and that they were going to miss their earnings, which were scheduled for 2 weeks. So that caused a negative reversal, but we still opened positive across the board on the indexes. And then worked our way higher. You'll see this when we go over the charts momentarily, but then had a negative reversal in big cap arena and closed red on the day for the S&P and the NASDAQ. Leaders, however, very resilient, held up fine. G6, in fact, this is our small cap, mid cap, 6 ETF composite that we use in-house to track the health of growth leaders. Nice day today, up 0.75%. S&P 500, as I said, finished down 0.12 red. NASDAQ 100 down 0.22. Both tried, as I said, gap up breakouts, but failed back into their bull flags. We'll take a look at the charts momentarily, and you'll see what I'm talking about. Dow, slightly positive, the one large cap index that survived, not going red. Mid caps up 0.63, Russell 2000 up 1%. Global diversified 60/40 stock bond index just barely positive. Our in-house flagship GROTECTION portfolio down a sliver, down 0.10%. Let's get to the charts, but first let's get to an explanation of what we do here at Revere. Trend following is what we do across 3 time frames. As you saw on the trend gauge over here, we track leaders and we track the market indexes across 3 time frames, and then depending on the health of the overall market, that dictates how much of our clients' capital we're putting to work. If you want to take a look back at late 2021 when we were trending higher, for the most part, we were invested during this period. Start rolling over and consolidating, which we did in and out November and December, made higher highs late December, then started rolling over in January. This is when we started getting defensive. Short term is the green line on here. That's the 21-day exponential moving average. Red line is the medium term 50-day moving average. The black line is the 200-day moving average. The purple line is the 100-day moving average. We reference it, but not always, and don't put as much weight on it as we do the other 3. So when we started rolling over in early January, January 24th was the first day that we ended up being all cash. That was the first close below the 200-day moving average here. And since then, we've been rallying, fading, rallying, fading, rallying, fading. This was the big change in character on the market. It went from a sideways chop consolidation back and forth among the 200-day moving average to just a breakdown. And this was mid-April when this started happening. We got extremely defensive. We had the moving average, the long-term moving average rolling over, tried to get back above it, couldn't. The 50-day and the 21-day trending lower and below the 200-day moving average. And then we gave way below it on April 22nd. Big leg down, rally back up. We took a couple of positions here. Every time we get back up above the 21, we're going to start dipping some toes in the water because, as I said at the time, one of these rallies will stick. We went in here, got stopped out for a very small loss, went in here, got stopped out for a very small loss, went in here, got stopped out for a very small loss at first, and then came back in, and we're riding a 10% move higher right now. But we are a little bit too extended. This started last week. When you're extended and then you gap up, you have to be wary of a negative reversal. We were as high as the NASDAQ was over 6% above its 21-day moving average today with the gap. And then you had the NVIDIA catalyst in there for weakness, and the semiconductors really lagged all day. You can see here it bounced off the 100-day moving average and finished in the upper end of the range, but NVIDIA took it on the chin, down 6.3%. Let's show NVDA. Was showing really decent volume patterns and a nice move up off the lows from 140 up to 192, but big warning for them this morning, down 6.3%. Ironically, still holding the 21-day and the 50-day moving average, and maybe that's pointing to some underlying strength in the market. We still own a semiconductor name, ON, that held up just fine on the day. We bought another one that was green on the day, so maybe this is not as bad as the market might think it initially was with the gap down, but we do have to get back to the indexes, and a gap up and a failure. When you get that, you got to pay attention to it. You can say, yes, we're extended, but you see the gap up, you see the move higher, and then the hard rollover and reversal. You can look at it on multiple time frames, as we always do. Move up higher, fail, roll over, close near the lows of the day. But here was the breakout around this area here, 318.70-ish. We came back and held it on Friday when we had some bad news with the employment report. Sorry, good news with the employment report, but is from a contrarian standpoint actually bad news, because it would imply that the Fed is going to raise more. But we held that low. That's important. You got to keep an eye on that. Let's go back to the S&P 500 to see how we held relative to that. You see the gap above, new highs, and then a reversal. Still quite a bit above the 41.08 low here of Fridays. That's really the key area that I'm focusing on for whether or not this leg higher is going to have to take an extended break or not. But for now, gap above started to fail. When it failed, the SSO position that we added on Friday, we sold it for a very small profit, so we took some risk off there, and then we added a NASDAQ short as we started breaking down more, and I'll talk about that momentarily. But we also did add a couple of positions that were holding up very well. Ultimately, what we're going to do is let the market decide if it's time to pull back to the 21, to the 100, to the 50, or just break down altogether, or have a false breakdown out of this flag and just continue to go higher. We're open to any outcome, and we've got a plan for each of them. So there's your NASDAQ 100. Let's go to the Dow Jones Industrial Average. Breakout on the day, negative reversal back into this little flag that it had been forming. Mid caps here, here's a clean breakout, pull back just to the top of the flag though. So that breakout is still intact on the MDY and on IWM. Clean gap up, also closed near the bottom of the range, but with some very clear space. Note how it made a higher high on Friday and didn't give it up the way the big cap indexes did. Now another gap up, and it also held. So with the G6 being positive on the day, that's some feedback that's telling us that leading growth stocks anyway, are holding up just fine. So there are the indexes. We went through those. Now let's get to some individual names, but first we want to get caught up with the tail of the tape and see how that reflects on the NASDAQ 100 and on the S&P 500. So put call at a 1, VIX slightly up on the day. Would have expected it to be higher considering the big negative reversal, but no, we're hanging around at 50 on fear and greed. Still operating under the bull case. Here's the Inflation Reduction Act that passed the Senate, and then the NVIDIA pre-market miss and guide down. Big news that this might really slow tomorrow's trading a bit. We've got CPI before the open on Wednesday. We've got PPI before the open on Thursday. So definitely keep an eye on any inflation data is very key. That's really the biggest negative overhang to the market right now. The NASI, this is the McClellan Summation Index. This is very overbought. I talked last week about an overbought setup with the S&P versus an oversold setup on the US dollar, and that is still intact. So we don't always go up forever. And we want to be aware. Let me bring up this NASI chart here. And when it is, this can act as a tailwind or a headwind for the market. You can see here, you can see here how overbought it was. If this starts to roll over and this starts to put a negative hook on there, it really acts as a tailwind in whichever direction it's going. Tailwind if we're going lower, or headwind if the market's trying to go higher and we're heading lower on this. So it's another tool that we're paying attention to. We won't go up forever as part of this leg off the lows. It's a pretty decent extended move, over 10%. Maybe we're getting a little bit tired, but if we are, leaders, as I said, still holding up just fine. We'll take a look at those in a minute. So expectation for today, any bull flag breakout would hold on any pullback. We did gap up. We pulled back into the range. As long as Friday's lows hold, I am not going to get overly concerned with the NASDAQ 100 and the S&P 500, but we do have a hedge on for the big caps just in case, because it's the small and mid caps that have been outperforming lately, and I'll talk about that momentarily. So this support and resistance areas that we were watching, 4130 on the S&P, it held overnight. That was the low, and then it held again intraday when we tried to pull back. 4929 was where we bounced. The upside resistance, that 4178, which happens to be the high of this consolidation on the S&P 500, we popped above it intraday with the gap up, and that was as far as we go. So support and resistance very clearly held, and those are two big areas, 4130 to 4178, call it 4180 area. Keep an eye on those. NASDAQ 100, we have this big 315.59 fib area. Didn't test that today. I made a note of what the pivot, the pre-market pivot was, the pre-market high on the NASDAQ 100 before that NVIDIA news came out. It was 324.79. So we got above that in intraday, but we failed and rolled back over. So this 324.79 can act as an important resistance area, and 330, that's just a bit higher up. Not to worry there yet. In fact, I think that might be the 200-day moving average. Let me double check. That 330 area, no, that 330 area came from right here, which is when the last couple times we tried to rally in late April. That was as far as we got. The 200-day moving average is 6.7% higher at 343.56. Not as quite a big a move higher required to get to it on the S&P 500, 4.5% higher based on today's close. So what do we do in-house today? Well, let's talk about sectors. First of all, bonds were green. Biotech continued to be strong. TAN and ICLN benefited from the Inflation Reduction Act, which has a bunch of money in there for clean energy. However, ICLN did have a little bit of a reversal off the top, as you can see, tried to break out and failed. And Enphase, which is one of our holdings, just too far, too fast. People taking some money off the table with this today, but still no damage done to the chart. Retail was up big. Oils and gold and silver. Down today was UUP. The dollar still continues to play a key role in this whole thing. We've got one eye on where the dollar's moving and seeing how that's impacting where the overall indexes are doing. The SOX, as I mentioned, bad day today, and that trickled over into XLK. So we trimmed, as I mentioned, that SSO position when the breakout failed. That was what we added on Friday. And then we bought two. Let's take a look at this intraday. We bought SQQQ twice. First on this failed breakout, and then we bounced lower again, and then we added to it here, another bounce up, and ended up going lower. So we've got support here. This is really just a situation to where we want to offset. We have a lot of big cap tech long exposure with Apple, with Amazon, and with the tech portion of the S&P 500, which is very clearly big cap dominated. And then we also saw Tesla try to move today and reverse at the 200-day moving average. So this is one of the big seven in the NASDAQ 100, the big seven being Tesla, Apple, Amazon, NVIDIA, Microsoft, Google, and Meta or Facebook. The gap's up on Apple on their earnings. You can see it here. That's still holding. Had the negative reversal also. Amazon, that gap up, also still holding. But if these are going to come down and test the bottom of the gap up pivot, we can offset this with the SQQQ and provide a little bit more balance to our portfolio. So basically, we'll see what ends up winning. Is it going to be a controlled pullback, in which case we'll cash a little bit of this long in the NASDAQ 100 inverse ETF, SQQQ, or will these stocks continue to go higher? Will this be the bottom in for NVIDIA on this gap down? If they end up going higher, then we'll take the gains from these. They'll offset the SQQQ, and the portfolio will end up being neutral from that standpoint. But so we've got 10% SQQQ. Then what did we buy today? I was really impressed with the action in net. In fact, when the market was pulling back today, this entire time, net stayed solid as a rock. It did give some up toward the end of the day, but it was this strength here that made me buy net. So we've got a small 2% position in net. That looks like a little short stroke here at this point. If you look at a weekly chart, just consolidating after this big weekly move up and gap up on earnings. Understand that there's resistance overhead. But when you get big volume like this and an earnings gap up, you have to pay attention to it. We know that from history. And the other stock that we bought, MPWR, this has just been acting great since its earnings gap up and higher high, and now the fourth tight day in this area here between 520 and 537. We bought a little bit on the pullback today. We've got a minor profit in this, but it's actually not down 2%. There's just a big spread after hours on this. And it's got room to run. If you look at a weekly chart on here, it's in this flat base, just broke above this key 500 area on the earnings gap up, and relative strength at a new high, and just absolutely not giving anything up as far as the gains go since it had its earnings gap up. Great fundamentals, great technicals, great growth prospects, and higher today while NVIDIA dragged down the fabless sector. That was another reason why we went into it. So let's bottom line today. Gap up breakout, large cap negative reversal to red back inside the bull flag, but the leaders are okay. Nothing to get overly concerned about, as I said, unless we break Friday's lows, which is when we had that initial gap down on the positive employment report. If those lows give up, we'll start getting more defensive because we've got 2.8% down to the 21-day on the S&P. I don't want to just give these gains up that we have. We've got double-digit gains in our SSO, in the teens, in fact, and we've got 4.2% in the NASDAQ 100. At some point, this needs to get visited. I don't know if it'll happen now. I don't know if it'll happen next week. I don't know if we'll just break out and go higher, but we pulled our beta back a little bit today, volatility adjusted beta from about 1.2 to 0.8, and most of that is this 10% hedge in this SQQQ. So let's take a look at some other things that we own and how they acted today. Celsius has earnings tomorrow, hanging around this pullback area around 100. Earnings tomorrow. Got a small loss in this, but we'll probably hold it through earnings because it's sized so small. This is a very clear leader, and with that Pepsi deal that was just signed for distribution, that should mitigate risk to earnings somewhat. CELH, ON, other semiconductor that we own, flagging nicely for the last 3 days after its move up after an initial negative reaction to earnings. So that looks fine there. T-Mobile continues to just be a chugger, higher, just working its way higher day after day. Weakness on Friday was bought. Strength basically on everything was sold today, but still closed at highs since we own it. Silvergate had a big nice move up in the morning with the gap. You can't really tell that much on this chart because of the range, but a decent close on lighter volume and new closing highs since we bought it also. Enphase, we talked about this pullback just a little too far too fast. We want to add to this if it pulls back on lighter volume into the 21 or some support back around this area after it pulled back on that second gap up. LNTH was up nicely this morning, all-time highs, pulled back, closed just above the high. Nothing wrong with this either. Good fundamentals, good technicals, good combination, and then we added net, as I mentioned, and that's going to wrap it. So as always, I'd like to hear from you. You can email me, don@revereasset.com, or phone 855-REAL-WEALTH. That's 855-732-5932. So wrapping up, Monday, 8/8. This is Don Vandenbord with Just the Facts, telling it like it is. A little bit of a hedge on. We'll see what happens with the big NASDAQ stocks. We could very easily take this off, see if we're going higher or going to consolidate a little bit more after this nice move up off the lows. Thanks for listening and have a great day.